On July 1st, 2026, a single piece of news did something unusual. It made one stock surge nearly 9% and wiped out 17% of another company's market value. Same headline, same minute, opposite directions. Meta Platforms rose 8.8% in a single session. Its market cap jumped roughly $98 billion. At the same time, CoreWeave dropped 14%. Nebius collapsed 17%, losing nearly $12 billion in value in one day. The Philadelphia Semiconductor Index fell 6.3%. Micron dropped more than 10%. AMD fell nearly 7%. And yet, Apple, Microsoft, and Alphabet all closed higher. What kind of news causes that pattern? Not a product launch, not an earnings miss. A Bloomberg report that Meta is building something called Meta Compute, a cloud business to sell its excess AI computing power to outside customers. That's it. One company said it might start selling something it already owns, and half the AI trade ran for the exits while the other half piled in. This video is about why. Not who's right and who's wrong, but where the money is actually moving. Before we get to Meta, there's a number you need to hear first. $1.25 billion per month. That's what Anthropic, the company behind Claude, is paying SpaceX to rent the compute capacity of a single data center. Google signed a similar deal for $920 million per month. According to SemiAnalysis, which tracks hundreds of GPU cloud transactions annually, those prices are 3 to 4 times higher than what any neocloud charges for comparable capacity. And the contract structure is just as unusual. These are nominally 3-year agreements, but either side can cancel with just 90 days notice. They're effectively auto-renewing quarterly contracts, not long-term commitments. Why can SpaceX charge that much? Because normal neoclouds, companies like CoreWeave and Nebius, need multi-year contracts to cover their financing costs. They borrowed billions to buy GPUs. They can't afford to let a customer walk in 90 days. But SpaceX already owns the infrastructure outright. It's not financing anything. It already paid. That changes the entire negotiating dynamic. The customer gets flexibility. The seller gets pricing power. And the middlemen. They suddenly look vulnerable. Now Meta is about to do the exact same thing. In May 2026, at Meta's annual shareholder meeting, Mark Zuckerberg was asked directly whether the company would build a cloud business. His answer was careful. He said, and this is a direct paraphrase, "It's definitely on the table. We haven't done it yet because we think we can use the compute ourselves. But if at some point we feel like we've overbuilt, then selling it is an option. And that's part of why we're confident to keep investing." The market heard 2 words, overbuilt and selling. And on July 1st, when Bloomberg confirmed the plan was real, internally called Meta Compute, led by Meta's head of infrastructure and the leader of Meta Superintelligence Labs, the panic started. But the panic missed a critical distinction. Meta Compute has 2 parts. One is selling raw GPU capacity, competing directly with CoreWeave and Nebius. That part threatens the neoclouds. But the other part is hosting AI models for outside developers, the way Amazon offers Claude through Bedrock. That part could actually increase demand for compute, not decrease it. More developers building on more models means more inference, more training, more GPU hours consumed. The market treated both parts as the same bearish signal. They point in opposite directions. This is the part of the story that explains the 17% crash. CoreWeave has a $21 billion contract with Meta. Nebius has one worth up to $27 billion. These are not small relationships. For both companies, Meta is among their largest customers. Their entire business model was built on one assumption, that the biggest AI spenders would always need external compute capacity. On July 1st, that assumption cracked. Not because AI demand is falling, it isn't, but because the biggest customer in the room just said, "I might start selling what you sell." Here's an analogy. Imagine you're a landlord. You've built apartment buildings specifically because one giant corporation keeps signing leases for your units. Then one day that corporation announces it's not just building its own apartments, it's renting out the spare ones to your other tenants. You still have a signed lease, but the market just repriced every building you own. That's what happened to CoreWeave and Nebius. No contract was canceled. No guidance was cut. But the market realized that the value in AI infrastructure is shifting. From the companies that rent out compute to the companies that own so much compute they can afford to sell the excess. This is not a bubble bursting. Demand is still growing. CapEx is still rising. The question is not whether AI infrastructure will be built. The question is who captures the margin. And on July 1st, the market's answer started to change. So is AI infrastructure spending about to slow down? SemiAnalysis, one of the most closely followed semiconductor research firms, says the opposite. Their July 3rd report argues that Meta's 2027 capital expenditure will be, in their words, astonishingly high. Not lower, higher. Their logic comes down to one word: optionality. Meta now has 4 high-value paths for every gigawatt of compute it builds. First, train frontier AI models internally through Meta Superintelligence Labs. Second, expand its ad recommendation system, which Meta believes can scale by another 10 times. Third, license models from companies like Anthropic and resell access, similar to Amazon's Bedrock. Fourth, lease raw compute at SpaceX-level pricing, where just 200 megawatts allocated to outside customers could generate over $10 billion in annual revenue. If any one of those paths underperforms, the others absorb the capacity. SemiAnalysis called it, and this is their phrase, a CFO's dream. The ability to go all in on compute because every exit is profitable. But there's one variable that nobody can answer yet. Can Meta Superintelligence Labs actually catch Anthropic and OpenAI? If it can, the compute stays in-house and the return on investment is enormous. If it can't, the compute gets sold externally, still profitable, but a fundamentally different company. July 1st didn't answer that question. What it did reveal is something the market hadn't fully priced in. In the AI supply chain, the value is migrating, from building compute to owning it, from renting capacity to controlling it. Whether that migration is just beginning or already overextended, that's the question worth watching, not rushing to answer.